Welcome everyone to my channel. Myself Apurva Pandre. In this video, we are studying about cash ratio. Now, what is cash ratio? The cash ratio is a liquidity measure that shows a company's ability to cover its short-term obligations using only cash and cash equivalents. The cash ratio is derived by adding a company's total reserves of cash and near cash securities and dividing that sum by its total current liabilities. The cash ratio is also known as absolute cash ratio, is one of the stringent liquidity ratio. It defines the immediate ability of the company to pay off its short-term loans. Other vital liquidity ratio are the current ratio and quick ratio. The cash ratio is helpful for creditors in assessing the probability of timely payment of their dues. Here is the formula for cash ratio. Cash ratio is equals to cash and cash equivalents upon short-term liabilities, which is current liability. Cash includes only the balances lying as cash in hand and bank accounts. Cash equivalents are those short-term assets that are readily convertible to cash and are highly liquid, which includes stock, bonds, government securities, treasury bills, bank deposits, money market instruments, etc. The primary purpose is to include only those assets whose encashment is readily possible within a short time, say 3 months or so. Here, closing stock debtors and miscellaneous expenses are not considered because they are not the cash equivalent. Now, the current liabilities. This ratio intends to find out the capacity of the company to meet its short-term debts using its most liquid items. The short-term debts are debts repayable within 12 months of the operating cycle. Major items are sundry creditors, outstanding expenses, short-term loans and advances, bank overdraft, cash credit, provision for taxation, proposed dividend and unclaimed expenses. The more the cash ratio, the more efficient the company is in paying off its short-term dues. Moving forward to an example where I can show you how to calculate cash ratio. Here are liabilities and assets are given, where equity share capital are 50,000, reserves and surplus are 1,50,000, unsecured loans are 70,000, sundry creditors 50,000, outstanding expenses 18,000, provision for tax is 12,000. Asset side, fixed assets 50,000, investment 1 lakh, closing stock 50,000, debtors 25,000, cash in hand 15,000, cash at bank 35,000, bank deposit 55,000 and treasury bills are 15,000. Moving forward to the solution, we can see how cash ratio is calculated. Cash ratio is equals to cash and cash equivalent upon short-term liabilities, where cash and cash equivalent includes cash in hand, cash at bank, bank deposit, and treasury bills, whereas short-term liabilities include sundry creditors, outstanding expenses, and provision for tax. Next comes the interpretation. The interpretation of the cash ratio will vary from business to business. There is no such ideal ratio. Following is an indicative understanding of the ratio. First, cash ratio equals to 1, which means cash and cash equivalents are equal to the short-term liabilities. Next, cash ratio greater than 1, which means more cash in the system than required to pay short-term liabilities. A company's creditor will be happy with such a ratio as higher as possible because that will reduce the chances of any delay in paying his dues. But on the other hand, the company would like to keep it low or optimize to suit its requirement because idle cash means unwanted loss of interest cost. Next is cash ratio lower than 1. which means cash in the system is insufficient to pay for short-term liabilities. A creditor of the company will assume more risk while extending credit to the company. In this case, they will rely on the company's previous track record. The lowest possible cash level with no delays in creditors' payment in the company make the management happy because they see the saving in the terms of interest cost on the idle cash and effective cash management. Thank you for watching my video. Hope it was helpful for everyone.